You've seen the headlines, right? The promise of quick riches, the crazy gains. It's what pulls so many people into crypto trading. But, beneath the surface of those exciting charts, there's a whole series of traps, and they're basically designed to exploit our most predictable human behaviors. In this explainer, we're going to pull back the curtain on how the crypto market really works. To really get a handle on this, we need to start with the story. And honestly, it sounds completely made up, but I promise you, it's 100% real. It's a story about a joke that somehow, someway, became worth millions of dollars. Yep, you are reading that correctly, FARTCOIN. A meme coin with zero utility, no cash flows, and a name that is, well, literally a joke. And it reached a valuation of nearly $750 million. It's absolutely absurd, which makes it the perfect place for us to start digging. This is the big question, isn't it? How on earth does an asset with no actual intrinsic value get a market cap bigger than real-world established businesses? The answer tells you everything you need to know about the game being played. And trust me, it's not what you think. So how do people get lured into this? Well, it usually starts with the tools. When a new trader first looks at a crypto chart, they don't see total chaos. They see something that looks, well, it looks like a science. This is the go-to for most retail traders. It's called technical analysis. And it's a framework that promises you can find order in all that noise, that you can predict the future just by analyzing the past. It feels rational, it feels scientific, a whole world away from just rolling the dice. And the basic building block for all of this analysis is surprisingly simple. Each one of these little candlesticks you see on a chart, it tells a tiny story. A story about the battle between buyers and sellers over a certain amount of time. Traders learn to read these patterns, believing they hold the secret to the next big price move. And here is the fundamental disconnect. You have all of this serious, methodical analysis, the charts, the indicators, the patterns being applied to assets like FARTCOIN, which have no real value to begin with. It's kind of like using the blueprints for a skyscraper to analyze a sandcastle. The tool just doesn't fit the job. So, if the charts aren't telling us the whole truth, what is? We have to look beneath the surface, at the hidden mechanics of the market. So let's break down the traps that are set up specifically to catch unsuspecting traders. Okay, so the very first trap actually involves the tools that most traders are taught to rely on from day one. Indicators like RSI and MACD, which are supposed to measure market momentum and trends, they feel like a fancy dashboard for the market, but they have a huge fundamental flaw. See, by definition, these tools are looking in the rearview mirror. These signal a great buying opportunity after a strong move has already happened, which is usually the exact moment the big institutional players are looking to sell to all the latecomers. They basically make you late to the party every single time. All right, tell me if this has ever happened to you. You set a stop-loss order to protect your position, you watch the price wick down and hit it perfectly to the penny, and then it immediately reverses and rockets in the direction you predicted all along. That wasn't just bad luck, that was very likely a liquidity sweep. This is a classic maneuver. The big players, they need a huge pool of buy or sell orders to fill their massive positions without moving the price too much. So where's the most predictable pool of orders? It's right where everyone else places their stop losses. So they engineer a quick move to trigger those stops, they absorb all that liquidity, and then they carry on. Now, this next trap operates on a much bigger scale. Instead of just targeting individual stop losses, it targets market psychology. It targets the stories we all tell ourselves about where the market is going. So, a bull trap fakes a breakout to new highs. This triggers a massive wave of FOMO, making everyone pile in right before the floor completely drops out. A bear trap does the exact opposite. It fakes a big crash, causing widespread panic selling right at the bottom. Both are specifically designed to exploit our most predictable emotional reactions. If there is one single, fastest way to completely destroy a trading account in crypto, this is it. Leverage. It magnifies your gains, sure, but it also magnifies your losses. And in a market this volatile, it makes blowing up your account almost a mathematical certainty over time. I mean, just look at that number, $1.7 billion. That's how much in leverage positions got totally wiped out in a single day. This isn't just a few people losing a bit of money. We are talking about billions of dollars vanishing as these automated liquidations just cascaded through the system. And behind those billions of dollars are the people.
Nearly 400,000 individual accounts were just completely force-closed, wiped out. This is the brutal, unforgiving reality of what happens when you mix high leverage with extreme volatility.
So, we've covered all the external traps, right? The ones set by the market itself. But honestly, the most dangerous traps are usually the ones that are internal. The crypto market is the perfect environment for our own cognitive biases to just run wild and sabotage our best intentions. Take a look at this. This is a real post from a real trader. Look at the language here. Confirmed. Perfectly. Predicted. This kind of absolute, unshakable confidence, this pattern seeking applied to a meme coin, this is exactly the kind of mindset that gets exploited. And here's the direct result. That feeling, the fear of missing out, or FOMO, seeing a coin pump like crazy and just impulsively jumping in, it's a pure emotional reaction. And making emotional decisions in trading almost always leads to the same outcome, buying at the top and selling at the bottom. I like to call these the 4 horsemen of account destruction. First, you've got overconfidence, which makes you totally underestimate risk. Then, the disposition effect, which means you cut your winners and hold on to your losers, the exact opposite of what you're supposed to do. Then there's herd behavior and FOMO, which is just impulsively following the crowd. And finally, revenge trading, making angry, emotional trades to try and win back money you just lost. It almost never ends well. So, after all of that, how does anyone actually succeed? How do you survive? Well, it all starts with drawing a very clear line in the sand between 2 totally different activities, investing and gambling. Think about it. Investing is about analyzing a business, its value, its cash flows. Gambling, like buying FARTCoin, is just betting on a number going up or down. One is a strategy for building wealth over time. The other is playing a game where the house has a massive edge. You really have to decide which game you want to be playing. A real, sustainable edge doesn't come from some secret indicator or a magical chart pattern. It comes from having a professional mindset. It means prioritizing not losing money over chasing huge gains. It means analyzing what's happening right now in the market's order book, not just what happened yesterday. And maybe most importantly, it means mastering your own psychology. Ultimately, you have to remember that the crypto market is an adversarial environment. It rewards the disciplined players, and it punishes the predictable, emotional ones. So the final question isn't really about the market, it's about you. In a game that's literally designed to exploit your predictability, how will you choose to play?